Very first thing is we encourage clients to talk to a lender about a financing strategy, or talk to their financial advisor, or talk to wherever the funds are coming from, whether it's coming from a work agreement, from a family agreement, etc., and to look at all of this up front. Clients tend to interpret that to mean, I want you to have a pre-approval letter before we look at houses. And that's not exactly what we're looking for. What we're looking for, and what we encourage you to know, is the type of loan that you will want to choose, where your sources of capital are going to come from, because those things impact the kind of property that you're going to buy. It's not just about the price, it's about how much down payment may be required for property A versus property B, and they can be different. And whether you'll be able to finance a certain type of property or not, or whether you'll be able to finance a certain type of property with the kind of loan that you want to get. And there are many more variables than just, I have this much money, I make this much money, therefore I can spend this much money, or I'm choosing to spend this much money per month. There are many facets to that I encourage clients to talk to a good lender up front to understand how these different choices will impact the finances of the transaction, how these different choices will impact their decisions. If you're looking at a condominium, there are several things about that condominium complex that can impact the types of mortgages that you can get. What is the owner occupancy of the complex? A lower owner occupancy can impact the variety of loans that you can get. It can require you to put down a much higher down payment. It could require you to pay cash instead of being able to mortgage the property at all. When looking at condos versus single families, many people would prefer a single family. They feel like that single family is cheaper because a condominium has a condo fee. However, if we sit and look at two scenarios, and you have a single family where you have to buy a roof that costs you $10 or $20 or $30,000, or you have to buy a heating system that costs you $10 or $20 or $50,000, or you have to do maintenance on the building, and you have the guaranteed expenses of a water bill and snow shoveling and maintenance, etc., versus living in a condo where you might pay $300 or $400 or $800 a month, but you don't expect to have those $50,000 bills come in for things that you have to fix by yourself in a single family. So being in a condo can mitigate that risk and can be a better financial choice. When looking at multifamilies and different types of loans, if you looked at a single family versus a two family versus a three family, there are different loans available for each product. Well, for a single family, you may target, say, $1 million, because that gives you a down payment that you're comfortable with and a loan amount and a rate that you're comfortable with. But you may be able to be in a similar or better financial situation by being in a two family that's at 1.2 or 1.3, because you can get a larger loan without changing your rate, without changing your down payment. This purchase and sale process is pretty unique to Massachusetts. It doesn't happen in a lot of other places. Deposit is quite large, and it really sneaks up on people. It comes up very fast. We encourage clients to have your deposit that you're going to use for your purchase and sale in cash or very near cash before you write an offer. Talk with your lender in the beginning about where those funds are going to come from, and then don't be moving them around. I encourage you not to move any money until you talk to the lender, and then put the money where they want it to be, and then don't move it. Every time you move it, the lender is going to ask for a paper trail, and that is not Zen.